Well, welcome to our webinar for this month. It's the Youth Month, June. You can see our topic there, Regulation 28, is it dampening returns for young investors? So I don't assume there'll be too many young investors on this presentation today, but unfortunately, the reality is that most young adults would like to begin investing and saving for retirement, but have no idea where to start. So those of you that are parents of young students and things like that, maybe this will be for you. But you can talk to any financial advisor and they'll tell you that one of the most important steps that any young person will take is to begin investing, number one, and number two, start saving money early and regularly. So it's our call it the crux of the presentation today. Today's webinar, we discuss whether young investors should be forced to dilute their potential return by holding other asset classes, number one, and number two, we will also be discussing whether having unrestricted access to offshore markets would further improve the investment performance and obviously the portfolio diversification. So good afternoon, everybody. My name is Sean van den Berg. I'm an investment specialist at PSG Wealth. Welcome to our presentation today. I think everybody's in now. Let's get going. So here's the agenda for today. Let's move to the next slide. There we go. Cool. So the idea today is we're going to discuss very broadly what is Regulation 28. Bottom line, it's there to benefit you. The aim of it is to spread risk and obviously your exposure to certain asset classes. And then I can spend a lot of time on owning or building a sensible portfolio. But bottom line, we're talking about the Regulation 28, which is part of the Pension Fund Act. Some of you guys might not know, but South Africa's pension funds manage over 4 trillion rands worth of assets. So retirement investing can be done via a retirement annuity, which is a great investment vehicle, or what we call a wrapper, as it's also known. So we're discussing that also. So just before we get into Regulation 28, let's talk quickly about a retirement annuity, because that would be the best vehicle for the young students, the young investors. The reason why I say it will be the best, one of the better investment vehicles, is because it helps save towards retirement with discipline. In other words, that you can invest, but you can't get access to that money until the age of 55. So you have to stay invested until the age of 55. So it's what I call forced savings, as I say, with discipline. Also, what's a nice thing about this, as I say, there's a lot of attractive tax benefits to it. So the contributions are tax deductible up to 27.5% of your income. There's obviously a limit to 350,000 Rand per year. So your contributions, monthly contributions, are tax deductible. There's no tax on interest or dividends or capital gains earned within the investment. Okay. So when it comes to retirement age, or age of 55, 1/3 can be taken as a lump sum, which a portion can be tax-free, but the balance, the other 2/3, must be used to purchase a living annuity or annuity. And this is the idea here, is to provide a regular income subject to tax where applicable. So this is the wrap of the vehicle, and within that, so first of all, you've got the tax benefits, and then obviously from there, with the Regulation 28, we have the advantage of asset allocation. So Regulation 28, as I said, is a rule in the Pension Fund Act that limits the equity, the property, and offshore exposure of a portfolio. It's extent to this that this provides broad diversification. That's the main thing we want to talk about today. Broad diversification, risk management, which basically translates into investor protection. That's the reason why we have this Regulation 28. So the equity market has historically been the best performing asset class over the long term, and young investors obviously would want to the investments or see the investments grow. So some investors, however, see that the limits of the Regulation 28, especially to the equity exposure, they see it as an obstacle, especially if you're decades away from retiring. And obviously they're looking for growth, and obviously looking for investments that can outperform inflation. So in that context, just want to bring up two slides here about the equity market. So this is looking at the JSE All Share, and obviously in this graph here, I can only go back to 1995. So you got a 25-year historical little chart here. You can see the ups and downs there over the market. This is the JSE All Share Index. Okay, so this graph started on the 2nd of October 1965, and the index at that point in time was at 5,022 points. Yesterday, when I took the screenshot, the index was at 55,913 points. So over a 25-year period, we're talking about 1,000% growth. Over 25 years, all works out to 41% per annum. So that's looking at the JSE All Share. Not too shabby if you look at that, but if you look at the S&P 500, this I took from Google Finance, this goes all the way back to 1980, to 27th of June 1980. So almost exactly 40 years later. So you can see the growth there over the long term. 2,612%, which works out to 65% per annum. So this is where a lot of people are griping, they're missing out on this opportunity. So the whole idea here, the narrative, as I say, that goes going along with this regulation 28 is that investors are being done in by this regulation 28 because it condemns them to low returns. If you look at those kind of returns, I don't think those are low returns. Regulation 28 basically limits the extent to which retirement funds may invest in individual assets or asset classes. That's the main thing. It's just limiting where fund managers can invest. So it's forcing them to diversify. So that although the aim is to protect investors from poorly diversified investment portfolios, some commentators will still say that the limit of 75% and 35% or 75% limit on the equity side and on the 30% on the foreign offshore would prejudice them. And we'll go into more details in the next few slides. But as I said just now, that yes, equities have historically been the best performing class. There are other opportunities too. So the whole idea here is having an asset mix is one of the, or the right asset mix is one of the criteria for a better performing portfolio. So asset allocation, number one, is one of the factors, and the other factor is obviously fees. Those are two things you have to take into consideration over the long term. Excuse me. So what is Regulation 28? Regulation 28, as I said just now, is part of the Pension Fund Act, and by extension, basically it's exchange controls. And these are contentious thing at the moment, especially in our day and age right now. But bottom line, it just sets a limit to where investors should invest their retirement savings. So as I said just now, it's to ensure your hard-earned savings are invested in a sensible way, and we'll talk about sensible investing just now, number one, and also obviously to protect you from poorly diversified portfolios. So it limits the maximum exposure to more aggressive asset classes like equities, but also especially when the initial investment selection is done, and we're going through that process just now. So this is the limitations you have. So the maximum exposure to various asset classes, you can see there, equities, property, international assets. Those are the three broad asset classes. The maximum exposure, if I bring my cursor in here quickly, where's my, whoops, the wrong button. Bring in my, sorry, pushing the wrong button here. Where's my, yeah. All right, so I'm not seeing it at the moment, obviously hidden. Yeah, yeah. So equities, 75%. That's when I say equities is all equities, both local and international exposure. Property up to 25%. That's local and international. Then offshore, if you look at offshore itself, excluding Africa, you can go up to maximum 30%. So that'll be maximum equities with 30%. If you're looking at including Africa, that will include up to 40%. So this is all prescribed by the South African Reserve Bank. So that's where the big argument comes in regarding this whole diversification. So I can get through the water quickly. So our South African share market obviously has taken some knocks over the short term, and these required thresholds will certainly provide some protection. That's the main thing I want to highlight for you guys. Value protection for individuals, especially those nearing retirement age, number one, and number two. In our environment of the local bond market rating, the downgrades recently we've seen, and the low offshore interest rates, as well as the volatile global equity markets, all this is it just provides a downside risk. Downside protection, let me put it that way. Let's go to the next slide. And this is where I want to explain a bit more for you guys. Okay, it's all for your benefit. Number one, so one of the criticisms we have regarding Regulation 28, that it places the burden of instilling the savings culture, the transformation, and other structural reforms on the shoulders of individuals. Okay, so the fund manager, I'm using example, the PSG fund manager will have their client's best interest at heart, number one, and they will not be just pursuing the government's policy. So the client itself, that's their focus. But saying that, and it goes to my last point here just now, they have the skills, the experience, and the know-how within that context to run these balanced portfolios. The second criticism most people have is that obviously the 75% limit imposed on equities. That's not really true in the sense that let me get my that local, you know, the whole idea is not just simply moving money from one vehicle to another. As I said just now, to protect investors in both bull markets and bear markets. So the aim is to spread risk and exposure. That's what we call prudent investing. Don't want to put all your eggs in one basket. So by limiting it to 75%, yes, you also have that other exposure where you can put into money markets, into bonds, offshore property, etc. So it's prudent, diversified portfolio. Okay, so when we talk about the 30% limit on offshore exposure, locally, there are some companies on the JSE, for example, NASPAS, which has a big weighting on the top 40, up to 18%, that gets most of the income from offshore. So there are a lot of locally listed companies deriving over half of their profits from overseas. That gives you greater exposure than just a 30% limited exposure. Obviously, a 30% limited exposure is direct exposure. Okay, so it does increase your exposure more if you're looking at the shares that are offshore, have offshore exposure. And then the other big criticism is that the lack of flexibility. But in fact, retirement fund managers now have greater flexibility and have more options. Okay, well, they still need to make judicious investment decisions within this whole Regulation 28 parameter. Okay, so I hope that's answered a lot of the criticism around it. So I want to spend some time on this. So this is for you that are considering starting a retirement annuity or choosing the funds for the retirement annuity. The whole idea here is that you want to, as I say, own a sensible portfolio. And sensible means a portfolio that is rational in the context of time horizon. Obviously, the younger you are, the more time you've got, but also building a well-diversified and regularly rebalanced portfolio. The nice thing about buying into the Regulation 28 funds, they're already balanced already. So they have to worry about regularly balancing them as such. So it's not easy to pick the best strategy over the next 40 years, number one. And number two, it's also not easy to navigate the markets with tactical switches. Okay, so if you have a long-term time horizon and you're going to build a sensible portfolio, that all will come into play just now when I go into more detail. So what investors should be focusing on more is looking at their own behavior and their choices rather than trying to perfect the asset allocation. So the starting point is, I suggest you guys go onto the website and go look at what we call the core fund list. What funds are available? Okay, we've got three tiers. or tier number 2 and number 3 will be more applicable for our direct clients, whereas tier 1 funds will be applicable only to financial advisor clients. But if you click on this little link here, you'll find that you'll be able to find the list. But from this list, for example, on tier 2 list, it'll highlight for you which funds would be compliant. It's automatically ticked. So I suggest as a starting point, go through this list and see which ones are applicable. And from there, take 5 at a time, and then go to what we call the Funds A to Z tool. And this tool helps you to compare, obviously, number 1, performances, number 2, the fees, and number 3, the risk of the portfolio. So you can go click in. What I do in mine, I just select all, and from a previous list, I go choose those funds 5 at a time, and then I go click on compare. Okay, from there, in this example, I came up with just two to simplify it. I got Alan Gray, the Balance Fund A, and PSG Balance Fund E. Okay, so you can see what they're involved in, how long they've been around, etc. The performances over the last few years. Obviously, it goes a bit longer for Alan Gray. I carried off here by 5 years because it just fit into the screen. And you can see, yes, the last few years, PSG Balance Fund hasn't done well, and the fund managers are very much aware of that. And but they are rectifying it, and you can see they are starting to bounce back. The last 3 months alone, you can see that PSG Balance Fund has increased by 24.7% as opposed to Alan Gray's 22%. Okay, so they are getting back. But the point I'm trying to make of this, and this is part of the research, when you go to the fund fact sheet, you can see in this situation, Alan Gray Balance A Fund, it will say it is compliance. So that you really know that it's balanced and things like that. I'll go into more detail just now with regarding the fees and things like that. This is PSG, the balance fund. You can see also again, it tells you it's compliant. So you don't have to worry about building a portfolio or get a trust that's going to be regulation compliant. Within the wrapper or retirement annuity, you are forced to buy balanced funds. So that work is done for you already. Yeah. And from there, and this is where I find it's interesting, I've taken the 2 asset allocation funds where this is until March on both of them. Okay. This is PSG Balance Fund, and this is PSG, the Alan Gray Fund. And they actually complement each other. So you can see here, domestic bonds, PSG funds are only at 24%, where Alan Gray has much less in balance in local bonds. But you can see how they complement each other. It's like it's intertwined. When one fund goes up, other one fund will go down, etc. So they all complement each other. And this is the idea that I want to get across here today. Please understand also, this is not advice. This is how you do your research and look for funds and then build up a portfolio of funds that will complement each other. Okay, so you can see, and this is part of your research, you'll compare the 2 funds. Yeah, this is looking at the top 10 holdings of PSG Balance Funds. You can do exactly the same thing with the Alan Gray Fund, where you can see what are they invested in compared to the previous quarter and the quarter before that. Okay, and again, you can design a portfolio that's going to complement each other. Okay. So guys, that's basically what I'm trying to get you today, is that using that approach and using regulation, as I say, the wrapper number 1, number 2, asset allocation, and you're getting that from a regulation 28 portfolio, and then doing your homework and choosing the funds and comparing funds, you'll have a much better performance than having to worry about being restricted to only 75% 75% equities and 30% offshore. So a quick summary before we get into the questions. Okay, so regulation 28, as I said, is a prudent set of rules and limits. That's what it is. Most investors do not have that. So the average investor does not understand market complexities. So this is just helping them choose funds, and you can see the bottom point there is the aim is for the right mix of low risk return safe assets with higher risk return innovative products. Okay, remember also you choose the funds, and once a year you can switch funds and things like that. That's number 1. And number 2, you can go so far as to get a financial advisor, give you better advice how to look at these funds. Okay. So in conclusion, for more information, please go to our website. You can go click on this this link in the presentation. Also take you through to the website on our retirement annuity. That link there will take you through to register for a retirement annuity. But the idea is to use the core funders as a starting point to highlight or focus on the balanced multi-asset funds. There's the word there, multi-asset, so it's diversified. And those are highlighted for you, as I say, the Regulation 28 funds. From there, you're going to use the Funds A to Z tool and help you compare performances. Basically, you want to hone down your selection process. Look at the fund fact sheets, and then from there, as I say, compare the fees. So when you look at PSG fees, we're talking about 0.35% as opposed to 0.5 for non-PSG funds. Okay. So as I say, this webinar is being recorded and the presentation will also be sent out tomorrow. So let me see what questions you guys have. Let me just get to my questions here. Cool. Okay. Any other NASPAS? I'm not 100% sure what you mean by any other NASPAS. Obviously, NASPAS unbundled proxies. I'm not 100% sure what you mean by that. Leon, what does the RMH drop mean because of the unbundling? If a first rand unbundled or RMH unbundled first rand, so you might just get shares, and whatever the share drop is, you're getting the shares in place of it. It's the same as when Remgro unbundled RMH, you got the shares in place of it. It's just the idea there is to unlock value. That's the main idea around unbundling. So over the longer term, you should benefit from it, Leon. I hope that benefits or answers your question. In the context, obviously, of a Regulation 28 fund, the fund manager will take it all in consideration and balance the portfolio and things like that. Are there any other questions coming through? Okay. The call list, where I find it. Okay, in the presentation, as I said, there will be a link where you'll be able to click on it. But anyway, if you go to PSG website and you go to investments, and from investments with all the different funds, remember we only spoke about one vehicle today, retirement annuities. There's also a voluntary investment plan, so you can construct a Regulation 28 compliant portfolio, but you're missing out on the benefits of the tax benefits around a retirement annuity, a wrapper, because it's more tax efficient vehicle. And as I say, the main vehicle for, I believe, for a young investor would be that a retirement annuity forces you to save and you can't get your money to it. So it's disciplined savings, forever savings, put it that way. Okay. Like those are all the questions. Cool. Okay, nice short presentation today. I've been told to keep it shorter, so I hope that was my objective today. So there's you can get a hold of me through the wealth box, the wealth email, wealth@PSG, number 1, and number 2, you can also phone our little toll-free line there. It comes through to me. Okay, so guys, from my side, thank you very much for being on this webinar today. As I say, there's my disclaimer. This was not for advice or anything, was just for education purposes to understand Regulation 28 further, and also the process, how to choose those funds. So from my side, thank you very much. Until next month. And next month, we'll be talking more about savings. It'll be savings month. We'll be talking about the magic of compounding. Okay. So from my side, thank you very much for being on this webinar again. Good luck and all the best. Bye for now.